Tod-Ai. The characters are fictitious and do not correspond to real people. Invest at your own discretion.
Hola, this is Todd. Welcome to my Tod-Ai report, market news with analysis and debates to better understand what is really happening in the financial world. In the next 10 minutes you will learn, how are the markets performing? What are the most important data to invest in? And in addition, a debate on macroeconomics. What is the real market situation? We are at a time when stocks remain at historically high valuations. After reaching record highs at the end of 2021, trend down to a low in October 2022, with a minimum in October 2022, and then remain above that floor ever since. Money supply has nearly doubled in 7 years in the United States as in other economies. This has been enhanced in the crisis of February 2020. Liquidity has also been on the rise since the 2008 crisis due to central bank stimulus. They changed their policy to a restrictive one in March 2022 and reduced balances until October 2022, at which time global liquidity also reached a low that has not been exceeded since. The correlation between markets and global liquidity is extremely high, and it seems logical to ask how this liquidity will evolve in order to place bets in the market. What are the most important data to invest in? Regarding the most important indicators to follow in the financial world, the inflation rate is down compared to what it was a year ago, but we are coming from very high rates in the previous year. If we look at the evolution of inflation for longer periods, we realize that we are at high levels not seen in decades. To understand, see the annual inflation evolution graph together with the 5-year inflation graph. We believe that the 5-year in blue better reflects the real evolution of prices, which continues to rise, and allows us to observe that what we pay for things is becoming more and more and is even higher than 20% of what it was 5 years ago. U.S. GDP growth and unemployment trends show stability in recent months. Retail sales downward trend, consumer savings and business performance may generate a recessionary climate in the medium term. If we understand retail sales as an important indicator of economic activity, we see that the amount in volume is growing, but if we weight it according to the monetary mass, we observe that proportionally to the existing money, retail sales have not even recovered to pre-2020 values. This means that all the money that has been being created in the economy by central banks has not gone to consumption and has been parked in financial assets that have been revalued. Organizations and institutions that could not pay their debts have been kept afloat. Governments have to deal with a high level of debt whose payments will be seriously increased from the end of the year due to interest rate increases. Borrowing more is now more expensive, and having to raise more in taxes is not easy if you go into recession. This would trigger the need for central banks to expand liquidity again. While household net debt has declined slightly over the past 5 years, public debt continues to grow and is expected to continue until at least 2053. Central banks have been raising interest rates over the past year at a strong pace, with the exception of China, which already had higher rates, and Japan, which is keeping everlasting low rates. In the United States they have been raised by 5% in 1 year in an attempt to stop runaway inflation. The following, our virtual characters Cindy Nero and Max Caro will talk about the market situation in depth. The philosophy of this program is that there should be debate and different opinions, and that the viewer should be the one to evaluate by his own criteria based on the pros and cons of each hypothesis.
Hola. We are in a situation where there is still a lot of money in the system that is mainly invested in housing, stocks, and financial products. After increasing the money supply and starting an upward inflation cycle, money as such loses its value and there is no incentive to save. There is a paradox. There is a general lack of attractiveness in the stock market and other potential investments at current valuations, but it is also not very attractive to save. It seems that those who have wealth and income from previous investments, such as renting a house or dividends, pay debts if you have them, or simply consume while waiting for another opportunity. But things change for the less wealthy. Things like buying a home or borrowing money have become unaffordable. High costs do not allow to save, and everything remains a matter of living from day to day as long as employment rates are maintained. The problem is whether to trust that everything will continue like this for a long time.
Hola! Central banks are selling us that they are opting for a very restrictive policy to combat inflation, but the reality is that they are not being so restrictive. Money supply is 40% higher than 4 years ago, rates rise for loans and mortgages, but they just do it for the savings. They seek that the capital generated is kept invested or used to reduce debt. Companies have started to reduce debt from 2022 and buy back shares of listed companies. Households also watch their debt levels, but have little or no savings. There is fear of debt, but governments are still running deficits and are going to have to face higher payments. Your debt can only be made smaller through inflation, as this devalues its real value and at the same time allows you to collect more. If corporate profits and salaries rise in line with inflation, this is perfect for reducing public debt, but this is not going to happen. Governments will have to stimulate the economy and central banks will have to do so as well. We have entered an unsalvageable cycle of a pyramid scheme where debt can only be saved with more debt.
I believe that the oligarchy wants to shrink the economy and focus everything more on governments and a smaller number of companies. The rest will have no power and no chance of having it. We will have a society that will be much more controlled in exchange for having what we need with less effort. I believe we will see a longer period of high rates and high inflation that will generate recession and concentration of power, and that will result in a change of rules with more controls and fewer freedoms. If debt is the only problem, we'll be reset. It does not necessarily have to be a bad or dystopian world like the ones in the movies, but we tend to.
I see something more traditional in terms of governance. Control is already in the hands of a few, and debt is their way of directing and generating labor force towards their interests. They will continue to feed this and have proven for decades that the only thing they know how to do when economic problems come is to print more money. The types, in spite of all, are low for the current inflation rate. As soon as there is a risk of debt default, a larger debt will be created to keep it afloat. Central banks have returned to buying gold because they know this. Coins lose their value when their available quantity is increased, but they are necessary to meet debts and tax payments. Only physical assets and the Bitcoin generate an alternative. For me, it is still unknown how the new technological advances will be absorbed, but will not change these bases.
It is also interesting to think about what can happen now that there is a lot of money in the hands of a few, but they do not want to invest it. If it is true that we will have high rates for some time to come, there will be debt defaults, and those fortunate enough to have liquidity will be able to go to the market to acquire assets at a good price due to debt defaults. Sounds cruel, but it's a possibility I don't see as too improbable.
Everyone wants to collect their debt, but I do agree that it may be more attractive to do so in tangible goods rather than in cash. If we extrapolate this to international loans, we may see countries in the hands of other countries, if this is not already the case.
As an overview, I see that high inflation over time will help governments and maybe some companies, but it will generate large class differences, destroying the standard of living of the middle class, which will have fewer possessions, but more technological wealth and the possibility of virtual evasion.
Be that as it may, we are going to a world of big differences between classes where you have to have real assets as long as you can and do not fall into the debt trap unless you believe that the borrowed money is for something profitable.
Interesting debate, although an easy future is not in sight. In the next episodes we will be increasing our financial literacy. Today we talked about macroeconomics, but we will talk about more topics such as crypto, energy, raw materials, housing, technology and many current news.